Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Marcus.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah. And before we really get going, I just want to mention that we are using StockOracle as our master guide for today's talk.
Right, exactly. StockOracle is an AI-aided stock research platform. Just a reminder, it is not financial advice.
Definitely not. Not a trading signal service, and it's not, real-time market data either.
Yeah, but it is a great tool, and we do have a special 14-day trial link below in the description if you want to check it out.
And full disclosure, that is an affiliate link, so the channel may earn a commission at absolutely no extra cost to you.
Right, and always remember, StockOracle's AI insights and their valuation estimates, they can be incomplete or just wrong. So always verify important facts yourself.
Always. Okay, so let's jump right into the wealth building context for Marcus, because this one is, well, it's pretty wild.
It really is. I mean, imagine looking for a growth play, and you decide to invest in a company that runs movie theaters and hotels.
Right. Two industries that the internet basically swore were dead and buried like 5 years ago.
Exactly. Streaming was supposed to permanently kill the cinema, and short-term rentals were supposed to completely wipe out traditional hospitality.
Yeah, but Marcus is up over 100% in the last 52 weeks.
Over 100%. They were trading at, I think, under $13 a year ago.
Yeah, $12.85 at the low.
Right. And now they're hovering right around $30. So the whole point of our talk today is to figure out if this massive run is fundamentally justified.
Right. Like, are we looking at a real sustainable turnaround here or just, a momentum wave that's eventually going to run out of steam?
Exactly. So let's look at the fundamentals, starting with the most recent catalyst. Because to understand a 100% rally, you have to look at what just happened.
Yeah, their Q2 2026 earnings report, it completely, it just broke the consensus estimates.
It really did. Wall Street was projecting about $218 million in revenue for the quarter, and they delivered nearly $232 million.
Which is a solid beat on the top line, yeah. But the bottom line is what really caught my eye.
Oh, the net income swing was massive.
Right. They went from a $9 million loss in the prior year to a positive $15.8 million this quarter.
Wow.
Yeah. And earnings per share hit 51 cents. They crushed the 33-cent estimate by nearly 55%.
And here is the crazy part. If you look at the market reaction right after that print, shares actually dipped.
Yeah, about 4.6% in pre-market.
Right. So the market explicitly punished them for a massive earnings beat. Why does that happen? I mean, if you're a retail investor, that just looks broken.
Well, it's the mechanical reality of a stock that has run too far too fast.
Okay, what do you mean by that?
So in the 13 weeks leading into that earnings report, the stock had already surged 72%.
Oh, okay.
Yeah, so the market wasn't hoping for a good quarter. The algorithms, the institutional traders, perfection was basically already priced in.
So buying in at $30 already assumed they would crush the estimates.
Precisely. When a stock runs up 70% just on anticipation, the actual event itself becomes an exit liquidity opportunity.
Right, so the institutions see the good news hit the wire. Retail buyers rush in because they see the headline beat.
Exactly, and the institutions use that fresh retail buying pressure to just dump their shares and lock in those massive gains.
So that drop doesn't mean the balance sheet is suddenly flawed. It's just trader psychology.
Profit-taking, plain and simple.
Okay, so if the current price is, slightly divorced from the baseline reality because of that momentum, let's look at the sentiment. How are the analysts valuing this thing right now?
The analyst community is incredibly divided right now. It's actually fascinating.
Yeah, I saw Benchmark and Wedbush are super bullish.
Right. Benchmark raised its price target to $33. Wedbush maintained an outperform rating and bumped their target up to $34.
But then B. Riley steps in.
Yeah. B. Riley downgraded the stock to neutral and set a price target of $29.
Which is basically exactly where it's trading right now.
Right. And that divergence really comes down to how much you trust the future execution of the company.
Well, I have to say, I lean a bit more bearish on this valuation.
Yeah.
Because if you look at the trailing 12-month price to earnings ratio, the PE, it's sitting at nearly 40.
39.6, yeah.
39.6. You pay 40 times earnings for an AI startup, right? Or some cloud computing platform where you expect revenue to triple.
Yeah, not a company selling popcorn and renting out hotel rooms.
Exactly. especially when their trailing 12-month revenue growth is under 2%.
Sure.
Paying a tech premium for 1.8% growth just seems absurd to me.
Well, the mechanics of a 40 multiple on a legacy business like this, it implies the market expects massive margin expansion.
Okay, so they're not expecting top-line growth. They're expecting them to just get way more profitable.
Right. The bulls are betting that management has permanently changed the cost structure. So even if revenue only grows at 2%, they squeeze drastically more profit out of every single dollar.
But B. Riley's downgrade kind of points out the ceiling on that.
Yeah, a multiple of 40 on a slow-growing hospitality asset leaves zero margin of safety if they miss expectations by even a fraction of a cent next quarter.
That multiple compresses violently.
Exactly, and the stock price collapses with it.
And honestly, the way they are squeezing out that profit right now seems highly suspect to me. If we look under the hood at the fundamentals, the cash and debt, it tells a different story.
Yeah, the balance sheet shows about $26.3 million in cash, but they are dragging around $149.1 million in long-term debt.
Right. And to make their free cash flow look better, management has explicitly slashed their full-year capital expenditures.
Yeah, the CapEx guidance was cut down to the $45 to $50 million range.
Which immediately flips their operating cash flow, right?
No, instantly. In the first half of the year, they generated $38.7 million in operating cash flow.
Wow.
Yeah, up from a negative $3.6 million the year before. And their free cash flow proxy sits at a really solid $22 million.
But wait, they only look healthier today because they literally stopped spending money on the business.
It's the trade-off, yeah.
I mean, in hotels and theaters, the physical building is the product. It's not like software where you can just, optimize code. If you stop replacing hotel carpets, stop upgrading theater lobbies.
Right, you're just slapping a fresh coat of paint over water damage.
Exactly. Your cash flow skyrockets this quarter. But next year, the customers notice, the reviews tank, and attendance plummets.
And that is the central tension of asset-heavy industries. Capital expenditures are the lifeblood of a hospitality moat. But when you have almost $150 million in debt, management is forced to prioritize liquidity.
They just have to survive.
Right, they have to ensure they can service the debt if macroeconomic conditions get tighter. But by starving the physical asset to feed the balance sheet, you start a slow burn erosion of your competitive advantage.
You're borrowing against tomorrow's customer experience to pay today's bills.
Exactly.
But, looking at these catalysts, it makes me wonder if they even care about the competitive advantage a year from now.
Oh, the acquisition theory.
Yeah. If I'm a cynical investor and I see a company intentionally starving its assets to artificially inflate its free cash flow, that is exactly what you do right before you try to sell the company.
Right, you make the books look incredibly lean and cash rich.
Exactly. So some acquirer pays a premium before the carpets start to fray.
It aligns perfectly with the aggressive nature of these CapEx cuts. Because if the goal is long-term organic dominance, you reinvest in the moat.
You buy the best projectors, the best beds.
Right. But if the goal is a near-term exit, you optimize for immediate free cash flow. Private equity firms or larger hospitality conglomerates, they look for strong cash flow and identifiable fat to trim.
So management might just be dressing up the financials for a buyout. That's a huge underlying catalyst to consider.
It definitely is. But while we wait to see if a buyer actually emerges, we have to look at the technicals. Because right now, the algorithm's just trading the momentum.
Yeah, so looking at the chart, the stock is floating around $29.95.
Yeah.
Comfortably above its 20, 50, and 200-day SPIPL moving averages.
Right, all very bullish indicators. But the relative strength index, the RSI, is sitting at 71.8.
And anything over 70 means the asset is technically overbought, right?
Exactly. The buying pressure has outweighed the selling pressure for so long that it creates an imbalance.
I always look at an RSI over 70 like driving a car with the RPMs in the red line zone.
Yeah.
Or like a stretched rubber band.
Yeah, the rubber band is a great analogy.
You pull it further and further, tension builds up.
Yeah.
And eventually, the snapback is incredibly violent. The buyers get exhausted.
They do, but a high RSI doesn't mean the snapback happens today.
Fair point.
Right, like strong trends can stay mathematically overbought for weeks. Traders don't just blindly short a stock because the RSI hits 72. They wait for a structural breakdown in the actual price action.
Okay, so what is the trigger? If Wall Street algorithms don't care about the frayed carpets in the lobby, what tells them the trend is actually dead?
They watch the 50-day simple moving average, which is currently sitting at $24.76.
Okay, so 24.76 is the floor.
Right. It acts as a psychological floor for institutional algorithms. If the price drifts down to 28 or 27, automated buyers will step in to buy the dip.
But if it breaks,
If it slices through that 24.76 mark on high volume, the psychology flips completely. Algorithms programmed to buy the dip suddenly trigger stop-loss orders.
and that's what releases the tension in the rubber band.
Exactly. It causes a cascade of automated selling.
Wow. And honestly, looking at the risks and the bear case here,
Yeah.
that structural breakdown could easily be triggered by the underlying math of their business model.
Yeah, the margins.
The trailing 12-month net margin is just 2.87%, walking a tightrope without a net.
It really is.
We talked about how they made almost $16 million in Q2, but if you zoom out, the net income for the entire first 6 months of the year was under $500,000.
Right. $491,000.
Meaning the first quarter completely wiped out almost everything they built.
Yeah, they lost over $15 million in Q1 alone.
A business operating on a sub 3% margin is just fragile. One bad weekend, and they're back in the red.
And this is the purest illustration of operating leverage. In hotels and cinemas, your fixed costs are astronomical.
Property taxes, commercial rent.
Heating, cooling, baseline staff. You pay all of that, whether the theater is sold out or totally empty. The variable costs, like the popcorn kernels, are minuscule.
So if revenue drops just a little bit,
Your profits don't just drop a little bit. Your profits might drop 50% or go completely negative because those fixed costs eat through your thin gross margin instantly.
which explains the Q1 bloodbath.
Exactly. They just didn't have the volume of customers to clear that fixed cost hurdle. But once you clear it, like they did with summer movies and travel in Q2, almost every additional dollar flows straight to the bottom line.
So operating leverage is a massive multiplier. Huge windfalls in good times, unmanageable losses in bad times.
Yes.
And that means any macroeconomic headwind like inflation squeezing discretionary spending or just a bad crop of Hollywood movies could push them right back below that fixed cost hurdle.
Definitely.
And there's another massive risk here, right? These unconfirmed rumors about a large foreign stake.
Yeah, there's unconfirmed research pointing to a 9.2% ownership stake by non-U.S. advisors.
9.2% is a massive chunk of the float.
It is. It introduces a huge wild card. If a quiet institutional player holds nearly 10% of the company, they essentially have the power to swing the stock price drastically.
So if the macro data softens, or they just decide the multiple's too high and they liquidate,
Their selling volume would immediately overwhelm the retail buyers, and that massive dump of shares would easily snap that 50-day moving average we talked about.
triggering the algorithmic sell-off.
Exactly.
So the math here is just entirely unforgiving. We're looking at a legacy business that doubled its share price through extreme cost-cutting, one blowout quarter, and potentially some momentum algorithms.
Yep.
Resulting in a valuation that demands tech-level growth from movie tickets and hotel rooms.
Oh.
So balancing the fundamentals, technicals, and these risks. What is the final verdict?
Based on everything in our StockOracle guide today, the overall rating is a rating 6, which is a neutral stance.
Okay.
Yeah. A neutral rating acknowledges the operational success they had in Q2, but it recognizes that a 100% rally has already fully priced in that success.
The easy money has been made.
Right. The momentum is stretched, the RSI is high, and the risk-to-reward ratio is just no longer in the buyer's favor at $30 a share.
So for you listening, what's the long-term view? The real test is going to be the upcoming Q3 earnings in late October.
Absolutely. And when you look at those earnings, the headline revenue number won't actually matter as much as the condition of the underlying business.
Right. You have to watch to see if those drastic cuts to CapEx are finally catching up with them. If demand drops because the facilities are showing their age,
The cash flow illusion disappears.
and that 40 multiple valuation collapses.
But keep that acquisition theory in mind, too. If management keeps hoarding cash, paying down debt, and refusing to reinvest in the physical product.
It becomes increasingly likely they are polishing the balance sheet for a buyer.
Exactly. The ultimate endgame for Marcus might not be a return to glory, but just a lucrative sale to a larger conglomerate.
Squeezing every last drop of cash out before handing over the keys.
Exactly. It changes how you read every single financial decision they make from here on out.
It really does. Well, that's our neutral rating 6 view for today. And remember, if you want to run these kinds of metrics yourself, the StockOracle 14-day trial link is down in the description.
Highly recommend checking it out.
Definitely. Thanks for joining us for this look into the numbers behind the narrative. We will catch you on the next one.